guys, welcome back to another week of Mortgage Matters in Minutes. Again, I'm your host, Brent Rasmussen, owner of Mortgage Specialists. Today, we're going to talk about 3 different property types and what you need to know about those. And again, when we talk about property types, it might not be what you're thinking, like a ranch home or a 2-story or a 1.5 or a berm home. We're going to talk about the different kinds of properties that we look at as lenders and investors to rate the risk on your transaction. And the 3 that we're going to chat about here today are what's the difference between a primary residence, secondary residence, and investment property. Generally speaking, the reason why this makes a huge difference is for 2 reasons. One, IRS purpose, because of how you want to file your taxes and possibly pay the least amount of taxes. But then also how a lender or investor is going to look at those different types of properties, because there's different risks on a loan, whether it's your primary residence or it is your house that you rent out for Airbnb or long-term rentals or whatever the case may be. So we're going to talk about these different kinds of properties so you have a good understanding of a general piece of why they look and feel differently. Because if you ever Google the IRS and residency, there's many pages and many rules that exist. Depends on what your situation is, whether you've lived in a property for a good amount of time, whether you just recently come divorced, whether you've transferred across the country, so on and so forth. So let's first talk about the very simplest of residences, which is primary residence. And the reason we want to distinct the 3 is because most consumers would think, okay, the rate should be the same for every kind of loan or property that I want to finance. And that simply is just not the case. So primary residence gives you the best interest rates, because what has been proven over time is that those that have their primary home is most likely going to be the easiest of payments. They're going to keep up with their property, and everything's going to work out very well. If people have financial problems, they generally are going to pay their house that they live in all the time first over a second home or a investment/rental property. So a primary residence is going to mean one simple definition by the IRS is that you live in a property 24 months out of the past 60 months, or 2 years out of the past 5 years. The reason why we care about that is because that is what allows you to get around possible capital gains tax issues. There's many other tax implications here that we aren't going to get into because we're not an accountant or CPA. But that's primarily what lenders are going to look at. Are you going to be living there full time? Are you going to be renting it out? That might be a different story. So you must have your primary residence close to where you work. You can't have it 400 miles away unless your employer says you can work remotely. So financing is the easiest on primary residences. It allows for the lowest down payment. It allows for the best interest rates, obviously based on your credit, income, asset situation. But generally speaking, primary residence loans are the easiest to do. You also can look at doing FHA, VA loans on top of conventional as well. So let's talk about another type of property, which is called a secondary home. And what is a normal definition of a second home? That is a vacation home. That is a place up in the mountains where you go to ski, down by the ocean where you're on the beach. So a lot of people want to make a property a certain definition and try to maybe change what it actually is to get better tax purposes, loan purposes, whatever the case may be. Second homes used to allow for a little bit smaller of a down payment and a little bit better interest rates between investment property and primary residence. But due to the environment, the market that we're in, the different kinds of properties that are out there, generally right now, a second home interest rate is exactly the same as an investment property interest rate. Second home loans require 20% down. Investment properties require 25% down. So we're looking at the same rate and down payment on second homes versus investment properties. But on a second home, you might live in that property half of the year. So you're not renting it out for the full time frame, and maybe only renting out for a short time frame. But we're going to look at, do you have a primary residence, regardless if you have one or not? What's your intention? If you have to go show up and work in Omaha, Nebraska, but you're asking to buy a property in Florida, then that's going to be looking like a second home or investment property versus your primary residence. And why does underwriting care? Because the risk is different whether you're living in the house all the time or partially throughout the year. It is different. Whether people understand it or like it is a different story, but factually, we can show by numbers that the risk is much higher on those type of properties. So once you look at a second home, you're just looking at only conventional loans, minimum down payment of 20%, and rates closer to investment property rates. So last, let's talk about what an investment property is. Investment property is used to have your property rented out. You charge rent, you receive that as income, and then you're looking at owning that property like a business. You're receiving rent, you're paying expenses, you're hopefully making more money than you are having expenses, and that's what makes it an investment. You're putting money into something, and hopefully it's giving you that return. A lot of people use investment properties nearly for tax advantages than necessarily income per se, because of depreciation that exists with investment properties. But on the financing piece, let's look a little bit at that portion and look at down payment, minimum 20%, but generally speaking, 25% is going to get you a much better option for financing. Investment properties are going to be a little bit more challenging to qualify. They want to see you might have rental history. They might want to see you have additional assets, obviously great credit, great income, but they want to see if things go bad and that property is not being rented, do you have enough income and assets to support that property? Everybody can look at every rental property and say, well, yeah, if it's rented out, I'm gonna make money. But people forget that at certain times that particular property is not being used, rented out. So lack of income is coming in regards to that. So today we kind of chatted about three different kinds of loans, whether it's primary residence, secondary home, or investment property. But a lot of times people will mix and match where they're financing things at. They might have their current primary resident loan paid off, but they might take a loan just on that property because rates are cheaper to buy a second home or to buy an investment property. So you don't always have to have financing on the property that you're looking to obtain. You just want to look at all the options available to see what works best for you. And many of the time when we start looking at multiple properties, we encourage our borrowers to talk with their accountant to say, okay, in your situation, what looks and feels best? Because every person's situation is a little bit different. There's lots of different tax advantages and rules that are going to fall into place. But obviously, as lenders, we're still wanting to get the best type of situation for the consumer, best rate, best payment, best loan terms. And knowing what you're going to be doing the property makes an enormous difference. Again, I'm Brent Rasmussen, owner of Mortgage Specialist. We appreciate you checking us out. Do like and subscribe us and follow us each and every week for information in regards to real estate and mortgage financing. And we'll see you here soon. Thanks so much. Mortgage Specialists. Driven, trusted, reliable.